Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, and the information presented in this video is for educational and entertainment purposes only. It should not be considered as financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Always conduct your own thorough research and consult with a qualified professional before making any investment decisions. Your financial situation is unique, and the choices you make are your sole responsibility. Imagine two friends, Sarah and Mike. Fresh out of college, both bright, both ambitious, and both start investing for retirement on the exact same day. They each contribute $500 a month every single month for the next 40 years. They invest in nearly identical mutual funds that track the S&P 500, and by some miracle of the market, they earn the exact same average annual return of 8%. For 4 decades, they follow the same path, make the same contributions, and get the same market performance. You'd expect them to end up with the same amount of money, right? But they don't. Not even close. When they both retire at age 65, Sarah has $2.2 million. Mike, on the other hand, has just $1.7 million. Sarah is a millionaire twice over, while Mike is $500,000 poorer. What happened? Did Mike make a bad trade? Did he panic and sell during a downturn? No. The difference, the entire $500,000 gap, came down to a single tiny number buried deep in the fine print of his investment paperwork. A number he and millions of other Americans completely overlooked. That number was 1%. Sarah's mutual fund had an annual fee of just 0.05%. Mike's fund, which was recommended to him by a friendly advisor at his bank, had a fee of 1.05%. Just a single percentage point difference. It sounds like nothing, right? 1%. It's the tip you leave for mediocre service. It's a rounding error. But in the world of investing, that 1% isn't just a fee. It's a parasite. It's a silent thief that works against you, day after day, year after year, compounding its damage and siphoning away a massive portion of your future wealth. This isn't just a story about Sarah and Mike. This is the story of your money. This is happening right now, inside your 401k, your IRA, your kids' college savings plan. There are invisible forces at play, designed to be confusing, designed to be overlooked, that are actively transferring wealth from your pocket into the pockets of Wall Street. And the most powerful of these forces is the expense ratio. That's the villain of our story today. The expense ratio is the annual fee that all mutual funds and ETFs charge to cover their operating expenses, things like portfolio management, administration, and marketing. It's expressed as a percentage of your total investment. And here's the insidious part. You never see a bill for it. You never have to write a check. It's automatically deducted from the fund's assets, which means it directly reduces your returns before you ever see them. It's a ghost in the machine, quietly eating away at your growth. The purpose of this video is to turn on the lights. By the time we're done here, you will have a crystal clear understanding of what these fees are, how to find them in your own accounts, and most importantly, how to tell the difference between a fair fee and outright robbery. I'm going to give you a simple framework that will allow you to analyze any fund and instantly know if you're getting a good deal or if you're being taken for a ride. This knowledge isn't just academic, it's transformative. Understanding and acting on this information could be the single most profitable financial decision you ever make, potentially adding hundreds of thousands of dollars back to your retirement nest egg. Now, a thought might be creeping into your mind. It's a thought the financial industry has spent billions of dollars to plant there. You get what you pay for. Higher fees must mean a better fund, right? A smarter fund manager, better research, and ultimately higher returns. It's a logical assumption. It's also completely demonstrably false. Study after study, decade after decade, has shown the exact opposite to be true. The single greatest predictor of a fund's future performance isn't its past returns, its star manager, or its brilliant strategy. It's its cost. The lower the fees, the higher the investor's actual return. The legendary investor and founder of Vanguard, Jack Bogle, put it best. In investing, you get what you don't pay for. The less you give away in fees, the more you keep for yourself. It's the simplest math in finance, and yet it's the most widely ignored. Think about it this way. For a high-fee fund manager to just match the performance of a low-cost index fund, they don't just have to be as good as the market, they have to be better than the market by the exact amount of their fee year after year just to break even with you. If their fee is 1%, they have to consistently outperform the market by 1%. If it's 2%, they need to beat it by 2%. And the data is overwhelming. over any meaningful period like 10 or 15 years. More than 90% of these highly paid active fund managers fail to do it. They fail to beat their low-cost benchmark. They charge you a premium for expertise that, in the vast majority of cases, delivers inferior results. You're paying for a gourmet meal and getting a cold fast food burger. But here's where it gets even darker. That expense ratio? That number you see listed on Yahoo Finance or your brokerage website. That's just the beginning. It's the tip of the fee iceberg. Lurking beneath the surface are a whole host of other costs that can drain your account even further. There are things called sales loads, which are basically sales commissions you pay just to buy or sell a fund. These can be as high as 5% of your initial investment. Imagine putting $10,000 into a fund and immediately seeing your balance drop to $9,500. That's a sales load. Then there are 12b1 fees, which are hidden marketing and distribution fees that you, the investor, are forced to pay. There are account maintenance fees, trading costs within the fund itself. The list goes on. It's a labyrinth of charges designed to confuse you and enrich the people selling the products. The good news is you don't have to play their game anymore. The power is shifting back to the individual investor, to you. Because today we have access to incredible low-cost investment options that were unimaginable just a generation ago. We can build a globally diversified, world-class portfolio for a fraction of a percent in fees. We can cut the fat, eliminate the middlemen, and make sure that the returns generated by your hard-earned money actually stay in your account, compounding for your future, not for someone else's. So right now, I want you to do something. If you can, pause this video and pull up your 401k statement or log into your brokerage account. Find the list of funds you're invested in. We're about to go on a hunt. We're going to find those expense ratios. We're going to drag them out into the light and see exactly how much you're paying. For many of you, what you find will be shocking. You might discover you're paying 1.5%, or even 2% a year for funds that are chronically underperforming their cheaper alternatives. But don't feel bad. Feel empowered. Because today is the day that stops. Today is the day you take back control. Let's start by breaking down exactly where to look and what you're looking for. The first fee we need to master is the big one, the one that's always there, the net expense ratio. Let's dive in. The net expense ratio. It sounds official, maybe a little boring, but don't let the name fool you. This isn't just a number on a page. It's a silent partner in your investment. A partner that takes its cut of your money every single year. Whether your investment goes up, down, or sideways, it's a guaranteed win for them. Think of your investment portfolio as a bucket you're trying to fill with water. The expense ratio is a tiny, almost invisible hole drilled in the bottom of that bucket. It doesn't seem like much at first, just a slow, steady drip. But leave it for 10, 20, or 30 years, and you'll come back to find you've lost a shocking amount of water. That water is your future. It's your retirement, your kids' college fund, your financial freedom. And this leak, this expense ratio, is draining it away day after day. So what exactly is this number? The expense ratio is an annual percentage. It represents the percentage of your investment that the mutual fund company schemes off the top each year to cover its operating costs. It's all bundled together into one convenient, easy-to-miss number. But we're going to tear it apart. Inside that single percentage, there are three main culprits. First, and usually the biggest piece of the pie, is the management fee. This is what you pay the so-called gurus, the fund manager and their team of analysts, to pick the stocks, bonds, or other assets for the fund. They're supposed to be the experts, the ones with the secret sauce, the ones who can outperform the market. You're paying for their salaries, their research, their fancy computer systems, and their corner offices. In theory, you're paying for alpha, for market-beating genius. The question we'll have to ask later is, are you actually getting what you pay for? Second, you have the administrative costs. This is the boring, unglamorous stuff. It's the cost of keeping the lights on at the fund company. Think of things like record-keeping, customer service phone lines, accounting, legal fees, and paying the custodian bank that physically holds the fund's assets. It's necessary, but just like the management fee, it comes directly out of your pocket. And third, we have one of the most controversial fees in the entire investment world, the 12b1 fee. Now listen closely, because this one is a doozy. Named after a 1980 SEC rule, this fee is used for marketing and distribution. Let me say that again. You are paying the fund company to run advertisements to attract new investors. It pays for commissions to brokers who sell the fund and for those glossy ads you see in financial magazines. It does absolutely nothing to improve the performance of your investment. It's like going to a restaurant, paying for your meal, And then the owner adds a charge to your bill to pay for the TV commercial you saw that convinced you to eat there in the first place. It's a fee that many investor advocates have been trying to get rid of for decades. Yet it persists, quietly siphoning money from millions of Americans. So, how do you find this all-important expense ratio? It's not buried in some 500-page legal document you'll never read. They're required by law to make it relatively easy to find. The two best places are the fund's prospectus or, even better, the summary prospectus. It's usually on the first or second page in a clear table labeled Fees and Expenses. If you don't have that document handy, just go to any major financial website, Yahoo Finance, Morningstar, your own brokerage's site, type in the fund's ticker symbol, and the expense ratio will be one of the top-line stats you see. It will be right there in plain sight once you know to look for it. Okay, so you found the number. Let's say it's 1%. What does that even mean? 1% sounds tiny, right? Sounds harmless. This is the trap. This is the illusion. Let's do the math and expose the lie. Imagine you invest $10,000. If the expense ratio is 1%, you're paying the fund company $100 every single year. Year in, year out. Now, compare that to a low-cost index fund with an expense ratio of, say, 0.04%. The annual cost on your $10,000 is just $4. $4 versus $100. You're already saving $96 in the very first year. You could take your family out for a nice meal with that. But that's not where the real damage is done. The true horror of high fees is revealed over time, thanks to the brutal magic of reverse compounding. It's not just the $100 fee you lose each year. You lose all the future growth that $100 would have generated for you. It's a double hit. You pay the fee and then you lose the earnings on the fee forever. Let's run the numbers over 30 years. You invest $10,000 and let's assume a modest 7% average annual return. In Fund A, with that tiny 1% expense ratio, your money would grow to about $57,000. Not bad. But in Fund B, with a 0.04% expense ratio, that same $10,000 with the same 7% return grows to over $75,000. That is an $18,000 difference. The high fee didn't just cost you a few $1,000s over 30 years. Cost you a brand new car. Cost you a year of college tuition. It cost you years of financial security in retirement. It's a monster that was silently eating your future, and you didn't even know it was there. So what's a good number? For a passively managed fund like an S&P 500 index fund that just tracks the market, anything over 0.2% should be a red flag. The best ones are under 0.1%, and many are now below 0.05%. The competition is so fierce the cost is practically zero. For an actively managed fund, where you are paying for that supposed expertise, the numbers are higher. But even then you should be wary. A fund charging over 1.25% better be delivering some truly spectacular once-in-a-generation returns year after year. And the data shows almost none of them do. A more reasonable range for an active fund might be between 0.5% and 0.8%. Anything in that 1% or higher territory, and you need to have a very, very good reason for being there. Now, one final crucial detail. When you look up the expense ratio, you might see two numbers: a gross expense ratio and a net expense ratio. The net ratio is what you are actually paying today. The gross is the fund's total cost before any temporary discounts are applied. These discounts are called fee waivers. A fund company might offer a waiver to make a new fund look more attractive or to stay competitive. The net expense ratio is the number that matters right now. But here is the catch, and it's a big one. These waivers can expire. A fund might lure you in with a low 0.5% net expense ratio, but you fail to notice that the gross ratio is 1.5% and the waiver expires in 6 months. When it does, your fee could suddenly triple overnight without you even realizing it. Always check the fine print in the prospectus. If there's a waiver, find out when it expires. Don't get caught in that trap. By understanding the net expense ratio, what's inside it, and the devastating impact it can have over time, you've already taken a massive leap forward. You've turned on the lights in a dark room and seen the fee monster for what it is. But what if I told you this is only the beginning? The expense ratio is the fee that's always there, working in the background. But there are other more aggressive fees. Fees that ambush you. They're not part of the expense ratio at all. They charge you for the privilege of simply buying or selling the fund. They are called sales loads, and they can be even more destructive. So what exactly is this financial parasite? A sales load is, in the simplest terms, a commission. It's a fee you pay to a broker or a financial advisor for the service of selling you a particular mutual fund. It's not a fee for managing your money. That's the expense ratio. This is a fee for the transaction itself. It's like paying a $500 cover charge to walk into a restaurant before you've even seen the menu. And this commission doesn't go to the brilliant fund managers picking stocks. It goes directly into the pocket of the person who convinced you to buy it. This creates a monumental, glaring conflict of interest, but we'll get to that. First, you need to understand the three main ways this ambush is sprung on unsuspecting investors. The most straightforward and perhaps the most brazen is the front-end load. You'll see these on what are called A-share funds. As the name implies, you pay this fee right at the front the moment you invest your money. Let's say you've saved up $10,000. You're excited. You're finally putting your money to work. You give it to your advisor to invest in a fund with a 5% front-end load. You might think your account balance the next day will be $10,000, ready to grow. You would be wrong. Instantly, 5% of your money vanishes. $500 is skimmed right off the top and handed to the salesperson. Your starting investment is not $10,000. It's $9,500. Before your money has spent a single second in the market, before it has had any chance to grow, you are already in a $500 hole. Think about that. Your investment now has to grow by 5.3% just for you to get back to zero. You're starting the race a lap behind everyone else, just because you paid a toll to get on the track. This is money that will never have the chance to compound for you. Over 30 years, that $500 could have grown into thousands. Instead, it paid for someone's steak dinner the day you invested. If the front-end load is a punch to the gut, the next type is a hidden trapdoor. It's called a back-end load, or more formally, a contingent deferred sales charge, or CDSC. You'll find these on B-share funds. And they are dangerously seductive. Why? Because when you invest, you pay nothing up front. Your entire $10,000 goes to work for you from day one. Feels free. Feels like you dodged a bullet. But you haven't. You've just walked into a different kind of prison. A back-end load is an exit penalty. You only pay it if you sell your shares within a certain period, typically 5 to 7 years. The fee is usually highest in the first year, maybe 5 or 6%, and then it gradually decreases by a percentage point each year until it finally disappears. The fund company is essentially saying, "We'll let you in for free, but if you try to leave early, we're going to make you pay." This is where the trap snaps shut. Life is unpredictable. What if you lose your job in year 2 and need to access your savings? What if a medical emergency strikes? What if you simply realize this fund is a terrible performer and you want to move your money somewhere better? Too bad. To get your own money back, you have to pay the penalty. Let's say you need to pull out your $10,000 in year 3, when the back-end load is still at 3%. You'd pay a $300 fee just for the privilege of accessing your own cash in an emergency. It locks you into mediocrity, or worse. You become a hostage to your own investment, forced to stick with a subpar fund to avoid the pain of the exit fee. All while the annual expense ratio continues to eat away at your returns. Now we come to the most deceptive of them all, the C-share fund. C-shares typically have no front-end load and only a small back-end load. Maybe 1%. That disappears after just 1 year. Sounds like the best of both worlds, right? Wrong. C-shares are the death by 1,000 cuts. They have a secret weapon called a level load. This is an annual fee, usually around 1%, that gets charged every single year, for as long as you own the fund. It's in addition to the regular expense ratio. Think about it. That 1% level load is a permanent drag on your performance. It never goes away. Let's compare. That 5% front-end load on the A-share felt painful, but at least you only paid it once. With a C-share, after just 5 years of paying that 1% level load, you've paid the exact same amount. But it doesn't stop. After 10 years, you've paid 10%. After 20 years, you've paid a staggering 20% of your initial investment, not in a single chunk, but through a slow, silent bleed that you might not even notice. It's designed for investors who don't plan to stick around for the long haul, but the reality is that life happens, people forget, and they end up holding these funds for decades, making C-shares potentially the most expensive of all. A-shares, B-shares, C-shares. It's like choosing your preferred method of financial pain. So why? Why do these things even exist? Comes back to that conflict of interest I mentioned. Sales loads are the primary way many commission-based financial advisors get paid. They have a powerful incentive to steer you not towards the best fund for your future, but towards the fund that pays them the highest commission today. Their recommendation may have less to do with your financial goals and more to do with their own. They might even justify it, saying the advice they provide is worth the commission. But here's the secret the industry doesn't want you to scream from the rooftops. You don't have to play this game. There is another class of funds. A better class. They are called no-load funds. These are funds that have zero sales commissions. No front-end load. No back-end load. No level load. 100% of your money goes to work for you from the very first day. You can buy them, you can sell them, and you will never pay a penalty or a commission for the transaction. You still have to pay the annual operating costs, the expense ratio we talked about, but you're not paying an extra, unnecessary toll just to get in or out. So where do you find these magical funds? They're not hidden. Companies like Vanguard, Fidelity, and Charles Schwab built their empires on them. You can buy them directly without a middleman demanding a cut. By choosing a no-load fund, you are immediately putting yourself ahead of anyone who pays a load. You are starting the race on the same line as everyone else, with your full investment intact, ready to grow and compound for your future, not someone else's. The existence of sales loads is proof that in the world of investing, the most expensive advice is often the one that seems free. The person selling you a loaded fund isn't just an advisor. They're a salesperson, and you are the source of their commission. But now you know the game. You know what to look for and you know how to say no. You've disarmed the ambush. However, even within the pristine world of no-load funds, and buried deep inside that seemingly simple expense ratio, there are still other fees. Fees with cryptic names, designed to quietly siphon money from your pocket year after year. One of the most common is called a 12b1 fee, and it functions a lot like a stealth commission. It's a fee that goes by a code name almost like a secret government project, 12b1, named after the section of the Investment Company Act of 1940 that authorized it. This fee was born in 1980 with, believe it or not, good intentions. The idea was simple. Back then, many mutual funds were small. They struggled to attract new investors. So the SEC created a rule that allowed these small funds to dip into the investor's own money, the fund's assets, to pay for marketing, advertising, and distribution costs. Think of it like a community pool where everyone chips in a little extra to buy flyers and ads to get more people to join. The theory was, as the fund attracted more investors and grew larger, it would benefit from economies of scale. The costs would be spread across more people, and the overall expense ratio for every single investor would eventually go down. It was sold as a temporary solution, a short-term pain for a long-term gain. But that's not what happened. What began as a temporary growth hack for fledgling funds quickly morphed into something else entirely. It became a permanent, institutionalized way to pay the brokers and financial advisors who sold the fund. Instead of being used for a billboard on the highway, that 12b1 money was now being funneled directly into the pockets of the salespeople as an ongoing yearly commission. It's a trail commission. They sell you the fund once and they get paid from your investment year after year after year for as long as you hold it. Imagine you buy a brand new car. You pay the sticker price, you drive it off the lot. Now imagine that every single year, the car dealership automatically deducts 1/4% of the car's current value from your bank account to keep paying the salesman who originally sold it to you. 5 years later, 10 years later, you're still paying him. You would call that absurd. You'd call it a scam. Yet, in the world of mutual funds, it's a standard, legal, and shockingly common practice. That is the 12b1 fee. It's a subscription you were signed up for without ever seeing a checkout page. And because it's baked right into the expense ratio, most people never even notice it. It's not a separate bill you get in the mail. It's just a silent drag on your performance. A tiny leak in the engine that slowly but surely drains your fuel over the long journey of investing. Let's talk about how much fuel you're actually losing. These fees often range from 0.25% to a maximum of 1% per year. Let's take that common 0.25% figure. Sounds like financial dust. A quarter of a penny on the dollar. Who cares, right? You should. You should care a lot. Let's run the numbers on two investors. We'll call them Sarah and Tom. Both are diligent savers. They each invest $100,000 into a mutual fund that tracks the S&P 500. They both expect an average annual return of, let's say, 8% before fees. Sarah is savvy. She does her homework and finds a great index fund with a rock-bottom expense ratio of just 0.05%. Crucially, her fund has no 12b1 fee. Tom goes to a traditional broker. The broker puts him into a similar S&P 500 index fund. It also has a base expense ratio of 0.05%. But this one has a 0.25% 12b1 fee tacked on, which goes to pay the broker every year. So Tom's total expense ratio is 0.3%. The difference is just that 0.25%. Seems negligible. Let's fast forward 30 years. Sarah, with her 0.05% expense ratio, sees her $100,000 grow to approximately $958,000. A fantastic result. Tom, with his 0.3% expense ratio, sees his $100,000 grow to approximately $891,000. That tiny insignificant sounding 0.25% 12b1 fee, that stealth commission, cost Tom over $67,000. $67,000. That's a luxury car. That's a down payment on a house. That's years of retirement income. It vanished. Siphoned away 0.25% at a time to pay for a sale that happened 3 decades earlier. And the most insidious part? The more his money grew, the more he paid in raw dollars. The fee grew right alongside his investment, acting as a constant parasite on his success. This brings us to the single biggest problem with the 12b1 fee. It creates a massive conflict of interest. If you walk into an advisor's office, and they are compensated through these fees, are they going to recommend the absolute best, lowest cost fund for you? Or are they going to recommend one of the funds from the company that pays them the highest 12b1 fee? The system incentivizes them to prioritize their own paycheck over your financial future. It puts their interests in direct opposition to yours. This is one of the dirty little secrets of the financial industry, and it's why there's been a huge movement towards fee-only financial advisors who charge a flat fee or a percentage of assets, and do not accept any commissions or 12b1 payments. Their advice is untainted by this conflict of interest. So how do you protect yourself? How do you find this hidden fee? You have to become a financial detective. Every mutual fund is required by law to publish a document called a prospectus. It's long, it's boring, it's filled with legal jargon, and almost nobody reads it. But you have to. Buried inside that document, there's a standardized table, usually near the beginning, called the Fees and Expenses of the Fund table. In that table, under the section Annual Fund Operating Expenses, you need to scan down the list. You'll see management fees, other expenses, and then you'll see it. A line item that says 12b1 fees. It might be 0. If it is, breathe a sigh of relief. But if you see a number there, 0.25%, 0.5%, anything, you are looking at the stealth commission. You now know that a portion of your investment returns is being sliced off every single year to pay for marketing or, more likely, to pay the person who is recommending the fund to you. The good news is that investor awareness has forced a change in the industry. The rise of low-cost investing giants like Vanguard, Fidelity, and Schwab was built on the rejection of these kinds of junk fees. They proved that you could build enormous, successful funds without charging sales loads or siphoning money through 12b1 fees. They offer countless funds where that 12b1 line item is a beautiful, clean 0. Today you have more choices than ever to completely avoid this fee. You just have to know to look for it. So you've dodged the sales loads, you've scrutinized the expense ratio, and now you know to hunt down the sneaky 12b1 fee. You might think you're finally in the clear, but the fund companies have another trick up their sleeve. It's a fee designed not to get you in, but to punish you for getting out. It's a fee that can take a surprising bite out of your money when you least expect it, especially if you need to access your cash in a hurry. It's called a redemption fee, and it operates on a completely different timeline than everything we've discussed so far. Think of the redemption fee as the financial world's version of a "we were on a break" penalty. You commit to the fund, but if you try to leave too soon, you get hit with the charge. This isn't about a long-term relationship. We're talking about a very short window, typically 30, 60, or maybe 90 days after you buy your shares. If you sell within that time frame, the fund might charge you a fee, usually a small percentage like 1 or 2% of the money you're pulling out. Now, your first instinct might be to get angry. What? Another fee? I just bought this thing, and now you're charging me to sell it. And that's a fair reaction. Feels like a penalty for changing your mind. But to truly understand the redemption fee, we have to look at it from the fund manager's perspective. Let's pull back the curtain on the inner workings of a massive mutual fund. Imagine a fund manager. Let's call her Jane. Jane is responsible for $1 billion portfolio. Her job is to carefully select stocks, bonds, and other assets that align with the fund's long-term strategy. She's not day trading. She's building a portfolio designed to grow steadily over years, even decades. Her success, and the success of all the investors in her fund, depends on stability and a long-term vision. Now, into this carefully managed ecosystem comes a disruptive force, the short-term trader. Let's call him market timing Mike. Mike doesn't care about Jane's long-term strategy. He just read an article online that says a certain sector is about to pop. So he dumps $1 million into Jane's fund on a Monday, hoping to ride a quick wave. But by Thursday, the news changes. A different sector looks hot. So Mike yanks his $1 million right back out. For Mike, it's just a quick trade. But for Jane, it's a massive headache. When Mike's $1 million came in on Monday, Jane had to put that cash to work. She couldn't just let it sit there, earning nothing. So she bought stocks according to her strategy. This incurs transaction costs, brokerage commissions, bid-ask spreads, small frictions that add up. Then just 3 days later, Mike wants his money back. Now Jane has to sell $1 million worth of stock to raise the cash for his redemption. This again incurs transaction costs. Worse, she might have to sell a stock she really wanted to hold for the long term, disrupting her entire portfolio strategy, just to accommodate one person's impulsive decision. Now imagine this isn't just one Mike. Imagine there are hundreds of Mikes, jumping in and out of the fund, treating it like a high-frequency trading vehicle. This constant churn, this hot money flowing in and out, creates a cascade of problems. It increases the fund's operating costs, which are ultimately borne by all the shareholders. It can force the manager to hold more cash than she wants to, just to handle potential redemptions, which drags down the fund's overall performance. And it can even trigger unwanted capital gains distributions for the remaining investors when the manager is forced to sell winning positions prematurely. The long-term investors, the people who are patiently saving for retirement or their kids' college education, end up paying the price for the disruptive behavior of the short-term traders. This is where the redemption fee comes in. It's not a money grab by the fund company. In fact, this is the most crucial detail. The money collected from a redemption fee does not go into the fund company's pocket. It's paid directly back into the fund itself, becoming part of the fund's assets. Let that sink in. The redemption fee is a penalty paid by the short-term trader that directly benefits the remaining long-term investors. It's the fund's way of saying, if your actions are going to cost the rest of us money, you're going to be the one to reimburse the fund for those costs. It effectively compensates the loyal shareholders for the disruption and expenses caused by the market timers. So this fee, which at first glance seems like another annoying charge, is actually a protective shield. It's a mechanism designed to discourage the kind of rapid-fire trading that harms the health and performance of the fund. It tells market timers, this fund is for serious long-term investors. If you're looking for a short-term gamble, you might want to go somewhere else. For the average investor, the redemption fee is almost a non-issue. Most people buy mutual funds with the intention of holding them for years, not days. The only time you might encounter it is if you have a sudden unexpected emergency, right after making a large investment and are forced to sell. It's an unfortunate situation, but it's rare. The fee is specifically targeted at a pattern of behavior, not at the average person. You'll find the details of any redemption fees in the fund's prospectus, usually under a section titled Fees and Expenses or Shareholder Information. It will clearly state the fee percentage and the holding period required to avoid it. For example, a 2% fee on shares redeemed within 60 days of purchase. Some funds have them, many don't. Funds that are more susceptible to market timing, like those investing in volatile international markets or specific trendy sectors, are more likely to implement them as a defense mechanism. So we've now covered the major fees that happen when you transact, when you buy with sales loads, and when you sell too quickly with redemption fees. These are like event-driven charges. You make a move, you might pay a fee. They're noticeable. They show up on your statement as a clear deduction when you make a trade. They're like the cover charge to get into a club or the valet fee when you leave. But these are not the most important fees. They're not the ones that have the most profound long-term impact on your wealth. The most powerful fees, the ones that can secretly erode tens or even hundreds of thousands of dollars from your retirement nest egg over your lifetime, are the ones you don't see. They don't happen when you buy or sell. They happen every single day. They are silent. They are relentless. They are deducted from your investment returns before you ever even see them. It's a constant, slow, almost invisible drain on your portfolio's performance. It's like a tiny leak in a giant dam, unnoticeable from one day to the next, but over the course of 30 years, it can be the difference between a comfortable retirement and just getting by. This is the world of annual fund operating expenses, and at the very heart of it is the most critical number you need to know. the expense ratio. So what is this number, this expense ratio? Think of it like this. When you buy a mutual fund, you're not just buying a basket of stocks. You're hiring a team. You're hiring a manager, analysts, accountants, and lawyers. You're renting office space in a skyscraper. And all of those people and that office space, they don't work for free. The expense ratio is simply the price tag for all of that, expressed as an annual percentage of the money you have invested. If a fund has a 1% expense ratio, it means that for every $10,000 you have in the fund, you are paying $100 per year every year to keep the lights on and the managers paid. Now, $100 might not sound like a lot. You might spend that on a nice dinner. But this isn't a one-time dinner. This is a subscription service you can't easily cancel, and the price is based on your entire net worth in that fund, not just your profits. Imagine you start a business with a silent partner. But this partner's deal is a little strange. They don't take a percentage of the profits. They take a percentage of the entire company's value, every single year. If the company has a great year and makes a ton of money, they take their 1%. If the company has a terrible year and loses money, they still take their 1%. That's how the expense ratio works. It's a guaranteed payday for the fund company, taken directly from your investment, regardless of how well they actually perform for you. It's a headwind you are constantly fighting against. So, what are you actually paying for? The expense ratio is typically broken down into three main ingredients. The biggest piece of the pie is almost always the management fee. This is the salary for the portfolio manager and their team of analysts, the supposed geniuses who are picking the stocks and bonds. This fee can vary wildly. Are you paying for a world-renowned Michelin star financial chef to cook up your portfolio? Or are you paying a premium for a line cook who's just following a basic recipe? The management fee is the price of that expertise, real or perceived. The second ingredient is often one of the most controversial, the 12b1 fee. That name sounds like a droid from Star Wars, but it's actually far less helpful. A 12b1 fee is, in simple terms, the fund's marketing budget. You, the existing investor, are paying for the fund to advertise itself to attract new investors. You're paying for the glossy brochures, the television commercials, the sales commissions paid to brokers who push the fund. Let me repeat that because it's as absurd as it sounds. Part of your investment return is being siphoned off to pay for marketing to convince other people to invest. It does virtually nothing to benefit you, the person actually paying the fee. It's like paying your gym a monthly fee. And a portion of that fee goes toward printing flyers to convince your neighbors to join. It's a major red flag. And a fee that many investor advocates argue shouldn't even exist. The third and final ingredient is a catch-all category called other operating costs or administrative fees. This is the boring but necessary stuff. It's the cost of postage for mailing statements, the legal fees for filing paperwork with the SEC, the accounting and auditing costs, the fees for the board of directors. It's the cost of keeping the whole operation running smoothly. While necessary, these costs should be minimal in a well-run, efficient fund. So you have the manager's salary, the marketing budget, and the office expenses. Add them all together, and you get your total annual fund operating expenses, expressed as that single critical number, the expense ratio. But here's the most insidious part, the true genius of how this system is designed. You never get a bill. You'll never open your mailbox and find a statement from the fund company saying, "You owe us $123.54 for this year's expense ratio." Oh no, that would cause outrage. People would see the money leaving their account and immediately question it. Instead, it's taken from you by stealth. The expense ratio is calculated daily, as a tiny fraction of a percentage, and deducted directly from the fund's assets. This means the value of your shares, known as the net asset value or NAV, is just a tiny bit lower every single day than it otherwise would have been. It's death by 1,000 cuts. A 1% annual fee doesn't sound like much, but it's about 1/365th of a percent siphoned away from you every single day, rain or shine. This leads to a massive misconception. When you look up a mutual fund's performance and see that it returned, say, 8% last year, you might think, great, I earned 8%. But that's not the whole story. That 8% is the net return. It's the return after the fund company has already paid itself. The fund's actual or gross return might have been 9%. But they took their 1% expense ratio off the top and only showed you the 8% that was left over. They don't show you the money you could have had. They just make it disappear before it ever hits your account. The fee is rendered invisible. And this invisibility is where the real damage is done over decades of investing. Let's go back to that $100 on a $10,000 investment. That's just year 1. In year 2, if your investment grows, you're now paying 1% on a larger amount. But the true cost isn't the fee itself. It's the lost growth on that fee money. The $100 they took in year 1 is $100 that is no longer in your account, no longer growing, no longer compounding for you for the next 10, 20, or 30 years. Let's make it real. Meet two investors, Sarah and Tom. They both start with $50,000 and invest for 30 years, earning an average of 8% per year before fees. The only difference? Sarah invests in a low-cost index fund with an expense ratio of just 0.05%. Tom, on the other hand, was sold a fund by a friendly advisor, and it has what sounds like a reasonable expense ratio of 1.05%. A mere 1% difference. What could that possibly matter? After 30 years, Sarah's account, with its tiny 0.05% fee, has grown to over $482,000. A fantastic result. Now let's look at Tom. That extra 1% fee, that invisible drag on his returns year after year, has been silently compounding against him. His final balance? Just $363,000. That 1% difference didn't cost him 1%. It cost him $119,000. A luxury car, a down payment on a house, years of retirement, vanished into thin air, all because of a number that seemed too small to matter. This is why the expense ratio is the single most reliable predictor of a fund's future performance. It's not about finding the smartest manager. It's about minimizing the headwind. The fee is a hurdle that the fund manager must clear every single year, just to match the market. A manager charging a 1% fee doesn't just have to be good. They have to be 1% better than the market every single year just to break even with a cheap index fund. And the data overwhelmingly shows that very, very few can do it consistently. You are paying for performance, but the fee is guaranteed while the performance is not. Understanding this one concept can change your entire financial future. It shifts your focus from chasing hot returns to controlling the one thing you actually can control: cost. So now the million-dollar question, or in Tom's case, the $119,000 question becomes, how do you find this number? How do you identify the low-cost champions from the high-fee wealth destroyers? Luckily, fund companies are legally required to tell you, but they don't exactly shout it from the rooftops. It's buried in a legal document filled with jargon that most people find so intimidating, they toss it straight into the recycling bin. And that's a tragedy, because that document, the fund's prospectus, is your treasure map to finding the fees. But let's be honest, when you first open that map, it looks less like X marks the spot, and more like a legal document written in a foreign language, designed by lawyers to be as dense and unreadable as possible. It's thick, it's full of tiny print, and it uses words that seem intentionally confusing. But here's the secret. You don't need to read the whole thing. Just like a car manual, you don't read it cover to cover. You just look up how to change the oil or check the tire pressure. For the prospectus, we're just looking for one thing: the price tag. So where do you find this document? It's almost always available online. Just search for the mutual fund's name or its 5-letter ticker symbol, followed by the word prospectus. The fund company is legally required to make this available to you before you invest. Once you have it open, usually as a PDF, your mission is to find a section near the very beginning, often on one of the first few pages, titled something like Fund Fees and Expenses or Summary of Fees. This is the Holy Grail. This is the part of the treasure map we care about. This section contains a standardized table. The SEC, the government agency that regulates investments, mandates its format, so it looks almost identical for every single mutual fund in the United States. This is fantastic news for us, because once you learn how to read one, you can read them all. The table is typically split into two parts. The first part is called shareholder fees. Think of these as one-time transaction costs. They're fees you pay when you buy, sell, or exchange shares. The most notorious of these is the sales load, sometimes called a sales charge. This is a fancy term for a commission. It's a percentage of your investment that goes directly to the broker or financial advisor who sold you the fund. A front-end load is charged when you buy the fund. If a fund has a 5% front-end load and you invest $10,000, $500 is immediately skimmed off the top. Your investment starts at $9,500. It's in a hole from day one and has to climb 5.26% just to get back to even. Then there's the back-end load, also known as a contingent deferred sales charge, or CDSC. This is a fee you pay when you sell your shares. It's contingent because the percentage you pay usually decreases over time. For example, you might pay a 5% fee if you sell in the first year, 4% in the second year, and so on until it disappears completely after 5 or 6 years. The idea is to discourage you from selling too soon, but it acts as a golden handcuff, locking you into a fund that might be underperforming, because selling it would trigger a hefty penalty. You might also see redemption fees, which are paid back to the fund itself to discourage rapid, short-term trading, and exchange fees if you move your money from one fund to another within the same fund family. Finally, some funds have account fees if your balance drops below a certain minimum. The key takeaway for this first table is that these are fees you can often avoid entirely by choosing no-load funds, funds that don't charge these commissions at all. And in today's world, there are thousands of excellent no-load funds to choose from. Paying a sales load is like paying a $5 cover charge to enter a coffee shop where the coffee isn't any better. Now let's move to the second and arguably more important part of the table: annual fund operating expenses. These are the fees that eat away at your returns every single day, year after year. They are insidious because you never see a bill for them. They are automatically deducted from the fund's assets, quietly reducing your overall return. This is where the famous expense ratio lives. This part of the table lists out the ingredients that make up that total expense ratio. First, you'll see management fees. This is what you pay the fund's portfolio manager and their team of analysts to pick the stocks or bonds. It's the single biggest component of the expense ratio. Next is the 12b-1 fee. This is one of the most controversial fees in the entire investment world. It's named after an SEC rule from 1980, and it allows the fund to charge you, the shareholder, for its own marketing and distribution costs. Let that sink in. You are paying the fund to run television commercials, print glossy brochures, and pay commissions to brokers to convince other people to invest in the fund you already own. It does absolutely nothing to improve your investment returns. It's a marketing fee, plain and simple, and it's a major red flag. Then you'll see a line item for other expenses. This is a catch-all category for the day-to-day costs of running the fund. Legal fees, accounting costs, administrative staff, postage, and so on. All of these individual percentages, the management fee, the 12b-1 fee, and other expenses, are added together to give you the total annual fund operating expenses. This final number is the fund's expense ratio. This is the number you need to burn into your memory. This is the percentage of your investment that you are guaranteed to lose to fees every single year, whether the fund makes money or loses money. If the expense ratio is 1%, you are paying $1 for every $100 you have invested every year. It might not sound like much, but as we've discussed, over decades it can consume a third or even half of your potential earnings. But the prospectus gives us one more incredibly powerful tool. Right below the fee table, there's another table, usually called the example. This is where the rubber meets the road. This table translates all those confusing percentages into cold, hard dollar figures. It shows you exactly how much you would pay in fees on a hypothetical $10,000 investment over 1, 3, 5, and 10 years, assuming a 5% annual return. This example is a game changer because it combines the impact of both types of fees, the one-time shareholder fees and the ongoing annual operating expenses. It will show two scenarios: one where you redeem your shares at the end of the period, and one where you don't. This lets you see the full devastating impact of a back-end sales load. For instance, a fund with a low-looking expense ratio but a high back-end load will suddenly look terrifyingly expensive in this table when you see the cost after 1 year. This is your ultimate comparison tool. When you're looking at two different funds, forget the jargon. Forget the marketing. Go straight to the prospectus, find this example table, and look at the 10-year cost. Fund A might cost you $800 over a decade. Fund B might cost you $3,000. Which one do you think gives you a better chance of reaching your financial goals? The math is undeniable. So the prospectus isn't a monster to be feared. It's an X-ray machine. It lets you see the hidden fractures and broken bones inside a mutual fund's fee structure. It empowers you to move beyond the slick advertisements and the confident sales pitches, and to make a decision based on facts. Finding it takes 30 seconds on the internet. Understanding the fee table takes 10 minutes of focused attention. And those 10 minutes could be the most profitable 10 minutes of your entire investing life, saving you tens, or even hundreds of thousands of dollars over the long run. The information is right there in black and white waiting for you. You just have to know where to look, and now you do. But knowing the fees is only half the battle. How do you know if a fee is high or low? What's a reasonable price to pay, and what's a complete ripoff? That's the million-dollar question, isn't it? Or, more accurately, the multi-million-dollar question over the course of your investing lifetime. Because the difference between a low fee and a high fee can literally be millions of dollars. The answer, which might surprise you, is that there is no single number. A good fee is entirely dependent on what you're buying. Think of it like this. If you're buying a car, is $10,000 a lot? Well, for a brand new Ferrari, it's an impossible steal. For a 20-year-old rusty sedan with 200,000 miles, it's a complete ripoff. You can't judge the price without knowing what you're getting. Mutual funds are exactly the same. The single most important factor in determining whether a fee is fair or a total scam is understanding the difference between two kinds of management: passive and active. Let's start with passive. A passively managed fund, often called an index fund, has a very simple, boring, and beautiful job: do nothing. Or more accurately, do as little as possible. Its goal is not to be clever, not to pick winners, not to outsmart Wall Street. Its goal is to simply buy and hold all the stocks in a specific market index like the S&P 500 and match its performance. Since the S&P 500 is just a list of the 500 biggest companies in the US, the fund's computer just buys those 500 stocks in the right proportions, and that's basically it. There's no genius fund manager with a crystal ball. There's no high-paid team of analysts flying around the world. It's an automated, computer-driven process. Because of this, the cost to run a passive index fund is incredibly low, and its fees should be rock bottom. This is non-negotiable. For a broad US stock index fund like one that tracks the S&P 500 or the total stock market, the expense ratio should be almost embarrassingly low. We're talking numbers like 0.04%, 0.02%, or even zero in some cases. Let me give you a ruler to measure with. For a basic US stock index fund, anything under 0.1% is considered very low. If you're paying more than 0.2%, you should be asking some serious questions. Paying 0.5% or more for a simple S&P 500 index fund isn't just a bad deal. It's financial malpractice. You are paying Ferrari prices for the rusty sedan. Now let's talk about the other side of the coin: active management. An actively managed fund is the exact opposite. It's the Ferrari. It has a star manager, a team of brilliant analysts, and a single ambitious goal: to beat the market. They believe that through superior research, clever timing, and expert stock picking, they can generate returns that are better than a simple, boring index fund. To do this, they conduct expensive research, they trade frequently, and they pay their managers massive salaries. And all of those costs are passed on to you, the investor, in the form of a much higher expense ratio. So what's a fair price for this promise of outperformance? For an actively managed US stock fund, you'll typically see expense ratios ranging from 0.5% to over 1%. A fund with an expense ratio around 0.6% might be considered competitive. Once you get over 1%, you are paying a significant premium. And if you're looking at more specialized funds like international or emerging market funds where research is more difficult and costly, fees can climb even higher, to 1.25% or even 1.5%. But here is the critical multi-trillion-dollar secret of the financial industry. The vast, overwhelming majority of those expensive, actively managed funds fail. They fail to beat the simple, boring, cheap-as-dirt index funds over the long run, especially after you account for their higher fees. Year after year, study after study proves this. So when you choose to pay that higher fee, you are not buying guaranteed better performance. You are buying a very expensive lottery ticket. A ticket that says you might beat the market. And the data shows that ticket is a loser more than 80 or 90% of the time over any given decade. Let's use a better analogy. An index fund is like buying a generic store-brand bag of flour from the supermarket. It's a commodity. It does the job perfectly, and your only goal should be to find the absolute cheapest bag on the shelf, because the flour inside is identical. An actively managed fund is like hiring a celebrity chef to bake you a cake. You're paying for their expertise, their secret recipe, their unique talent. You expect it to cost a lot more. But before you pay, you have to ask, is this chef's cake really going to be that much better than the one I can bake myself with the cheap flour? And even if it is this year, will they be able to bake a prize-winning cake every single year for the next 30 years? Because that's what you're paying for. So, the first step is to categorize your fund. Is it active or passive? If it's passive, the fee should be dirt cheap. If it's active, the fee will be higher, and you need to have a very, very good reason to believe that specific fund is one of the rare exceptions that can actually justify its cost. But there are other warning signs of a ripoff, and they often hide inside the expense ratio itself. One of the biggest red flags is something called a 12b1 fee. This sounds like a cryptic government form, but it's actually one of the slimiest things in the investment world. A 12b1 fee is a fee charged by the fund to pay for marketing and distribution. Let me repeat that. It's a piece of your investment that is taken out every single year, not to pay for research, not to pay the managers for their brilliant insights, but to pay the broker or advisor who sold you the fund in the first place. It's a trailing commission. It does absolutely nothing to improve your returns. It is a pure, unadulterated drag on your performance that exists solely to enrich the salesperson. A truly investor-focused, low-cost fund will have a 12b1 fee of 0. If you look at your fund's prospectus and see a 12b1 fee of 0.25%, 0.5%, and I shudder to even say it, 1%, you are very likely being taken for a ride. This often leads to another layer of fee confusion: share classes. You might see the same mutual fund, for example the American Funds Growth Fund of America, offered as Class A, Class B, or Class C shares. They all hold the exact same stocks, managed by the exact same people. The only difference is how they charge you. Class A shares typically have a front-end load, a commission you pay up front, but a lower ongoing expense ratio. Class C shares often have no front-end load, but they stick you with a very high ongoing expense ratio, usually including a fat 1% 12b1 fee that goes to your advisor every single year. They are almost never the right choice for a long-term investor. Class B shares are similar with high back-end fees, but they're mostly being phased out. The point is, these different share classes are just different ways of packaging the same product to pay a salesperson. The version you want is often called an investor or institutional share class, which strips out all those loads and 12b1 fees. It's the same cake, just without the ridiculously expensive box. So here's your homework. Go look up one fund you own right now. Find its expense ratio. Find out if it's an active or a passive fund. Look in the prospectus for a 12b1 fee. Based on the benchmarks we just laid out, under 0.1% for a passive US stock fund, and under 0.8% for an active one, how does your fund stack up? Are you paying a fair price for a Michelin star chef? Or are you paying a fortune for store-brand flour? The numbers might be small: 0.5%, 1%, 1.25%. It's easy to look at a 1% fee and think, what's the big deal? It's just 1%. That single thought is the most expensive mistake an investor can ever make. That 1% isn't just 1%. It's a monster in disguise, a termite chewing away at the foundation of your financial future. And just how much damage can that one little percent do over 10, 20, or 30 years? The answer is devastating. And it's what the financial industry hopes you never truly understand. Let's put this into perspective with a story. Imagine two friends, Sarah and Tom. They both just turned 30. They're smart, they're diligent savers, and on the exact same day, they each invest a lump sum of $25,000 for their retirement. They both choose a US stock mutual fund, and for the sake of our story, let's say the stock market delivers an average return of 8% per year for the next 35 years, until they both turn 65. They start with the same amount of money on the same day in the same market, earning the same 8% gross return. The only difference, the only variable, is the tiny number we've been talking about: the expense ratio. Sarah does her homework. She finds a low-cost S&P 500 index fund. Its expense ratio is a razor-thin 0.04%. It's practically a rounding error. Tom, on the other hand, gets a recommendation from a friendly advisor at his bank for a popular, actively managed large-cap growth fund. It sounds great, has a glossy brochure and a long history. Its expense ratio is 1.04%. Just 1%. A single penny on every dollar. In the grand scheme of things, what difference could that possibly make? Let's fast forward 10 years. They're both 40 now. Sarah, with her 0.04% fee, has seen her $25,000 grow to about $53,700. Not bad at all. Tom, with his 1.04% fee, has seen his investment grow to about $51,100. The difference is $2,600. Tom has paid $2,600 more for the privilege of being in his fund. He might not even notice it. It's a decent chunk of change, but it's not life-altering. He figures he's paying for professional management, so it's probably worth it. Now let's jump forward another decade. They're 50. This is where the magic of compounding, or the tyranny of it, really starts to show its face. Sarah's account, barely being touched by fees, has now ballooned to over $115,000. Tom's account has grown to about $103,000. The gap has now widened to $12,000. That's a nice used car. That's a family vacation to Europe. Starting to become real money. Tom has effectively paid the price of a car for his funds management, and he's still 15 years from retirement. But the final act is the most shocking. Let's go all the way to age 65. Retirement day. Both Sarah and Tom have diligently left their money to grow for 35 years. The market did its job, returning that 8% a year. Sarah opens her statement. Her initial $25,000 with that tiny 0.04% fee has grown into an incredible $368,000. A fantastic nest egg. Now it's Tom's turn. He opens his statement, expecting a similar result. But he's wrong. His final balance is $274,000. Let that sink in. $368,000 for Sarah. $274,000 for Tom. The difference is $94,000. $94,000 vanished into thin air. It's nearly 4 times his initial investment gone, wiped out by a tiny 1% fee. He and Sarah started at the exact same place and took the exact same market journey. But Tom arrived at his destination with a suitcase $94,000 lighter. Why? It wasn't just the 1% he paid each year. It was the ghost of that money. It was the earnings that would have been generated by the money he paid in fees. Every dollar that went to the fund company was a dollar that wasn't compounding for him year after year after year. The fee didn't just cost him 1%, it cost him all the future growth of that 1%. It's a double whammy. It's a leak in the engine that not only drains your fuel, but also damages the pistons over time. This isn't an exaggeration. Simple, brutal math. And it's happening inside millions of 401k and brokerage accounts across America right now. At this point, you have to be asking the logical question. Okay, I get it. The higher fee is a massive drag. But what am I getting for that fee? Tom paid for an actively managed fund. Sarah bought a simple index fund. Surely, the expert managers in Tom's fund, the ones with the PhDs and the fancy algorithms, were working to get him a better return than the market average, right? That's the whole sales pitch. This is the billion-dollar promise of the active fund management industry. They tell you, don't settle for average. An index fund like Sarah's is designed to just match the market. It's guaranteed mediocrity. We, the brilliant managers of this actively managed fund, will use our expertise to pick the winning stocks and avoid the losers. We will beat the market. We will outperform the index. That's what you're paying us the higher fee for. Sounds compelling. It sounds intuitive. You pay an expert to get an expert result. If you want a gourmet meal, you hire a chef. You don't just buy the ingredients. So, if you want market-beating returns, you hire a star fund manager. There's just one colossal problem. It's a promise that is almost never kept. The data on this is not ambiguous. It's not a subject of academic debate. It is one of the most settled conclusions in all of modern finance. The overwhelming majority of actively managed mutual funds fail to beat their benchmark index over the long term, especially after their fees are taken into account. Think about what that means. Tom was paying that extra 1% for the chance to outperform Sarah's simple index fund. But the statistics show that his chances were terrible from the start. S&P Dow Jones Indices releases a report every 6 months called the SPIVA report, which stands for S&P Indices versus Active. It's the industry's scorecard, and year after year it tells the same story. In their year-end 2023 report, they found that over a 10-year period, 91% of all U.S. large-cap active funds underperformed the S&P 500. Let me say that again because it is the single most important statistic in this entire video. 9 out of 10 professional fund managers with all their resources, research teams, and supposed expertise failed to do better than a simple, dumb, low-cost index fund. And it gets worse over time. Over a 20-year period, that number climbs to over 95%. So, what happened to Tom was actually a double tragedy. Not only did he pay $94,000 in fees, but he paid it for a service that had a greater than 90% chance of delivering worse performance than the cheap alternative. He paid a premium price for an inferior product. It's like paying double for a concert ticket, only to get a seat behind a pillar where you can't even see the stage. This is the great, uncomfortable truth of the investment world. The very thing you are paying for, outperformance or alpha as they call it, is so rare and so unpredictable as to be statistically irrelevant for most investors. Picking a winning active fund manager ahead of time is harder than picking a winning stock. The industry is built on selling the lottery ticket of outperformance, While the data screams that the surest path to winning is to simply buy the whole market through a low-cost index fund and stop paying for the ticket. This isn't to say that no active manager ever beats the market. Few do. But identifying which ones will do so in the future is a near impossible task. Yesterday's star manager is often tomorrow's cautionary tale. So, if paying high fees is a mathematical disaster, and the justification for those fees, the promise of beating the market, is a statistical fantasy, then what's the solution? How do you escape this trap? How do you make sure you're Sarah, not Tom? It requires a fundamental shift in how you think about investing. It means realizing that the key to success isn't finding the smartest person in the room. It's about controlling the one thing you actually can control: cost. It means embracing the elegant, powerful simplicity of not trying to beat the market, but simply trying to be the market for the lowest possible price. And there is an entire class of investment vehicles designed to do exactly that. They are the sworn enemy of high-fee funds. They are simple, they are transparent, and they have fundamentally changed the game for the everyday American investor. They are the key to building wealth and keeping what you earn. And they are precisely what we need to talk about next. So let's talk about the antidote, the solution to the slow, silent poison of high fees. We're talking about low-cost index funds and their close cousins, exchange-traded funds or ETFs. The concept is so simple it's revolutionary. For decades, the entire investment industry was built on a myth. The myth of the star fund manager, the genius stock picker who could consistently outsmart the market. They would charge you a hefty fee for their supposed expertise, promising to navigate the treacherous waters of Wall Street and deliver superior returns. But a man named John Bogle, the founder of Vanguard, looked at the data and saw the truth. He saw that the vast majority of these highly paid managers failed. They didn't just fail to beat the market. After you subtracted their fees, they dramatically underperformed it. He realized the game was rigged, not necessarily out of malice but out of simple, brutal mathematics. The market as a whole is the average of all its participants. For every genius who makes a brilliant trade, someone else has to make a foolish one. Before costs, active management is a zero-sum game. But after you subtract the high fees, the management salaries, the trading costs, it becomes a loser's game. You, the investor, are paying a premium for the privilege of underperforming. Bogle's idea was radical. He said, "What if we stop trying to beat the market? What if we just buy the market? Instead of hiring an expensive manager to pick a few dozen stocks they think will win, why not just buy a tiny piece of every major company in the United States? All of them. The winners, the losers, the mediocre ones in the middle. By owning the entire haystack, you're guaranteed to own the needle. You don't need to find it. This is an index fund. It doesn't have a star manager. It doesn't have a team of highly paid analysts. It's run by a computer algorithm with one simple instruction: replicate a market index, like the S&P 500 or the total US stock market. And because it's so simple, because there's no expensive genius to pay, the costs are microscopic. This is the fundamental shift in thinking you need to embrace. You are not paying for performance, you are paying for a service. The active fund manager is selling you a complex, expensive service with a very low probability of success. The index fund is selling you a simple, incredibly cheap service with a guaranteed outcome. You will get the market's return, minus a tiny, tiny fee. And over the long run, simply getting the market's return is a winning strategy. It beats the pants off of most of the pros. So, who are the champions of this revolution? The companies you need to know are Vanguard, Fidelity, and Charles Schwab. They are the titans of low-cost investing. Vanguard is the original. Their total stock market index fund, known by the ticker VTSAX, is a legend. For an expense ratio of just 0.04%, you can own a piece of over 3,000 US companies. That's not a typo. 0.04%. For every $10,000 you invest, you are paying just $4 a year for the management of that fund. Compare that to the $100 or $150 you might pay for an actively managed fund. That difference, $100+ every single year, stays in your account, compounding for you, not for a fund manager. The competition saw Vanguard's success and had to respond. Fidelity and Schwab entered the fray. And the fee war has been a massive win for investors. Fidelity famously launched a line of zero expense ratio funds. Their Fidelity Zero Total Market Index Fund, ticker FZROX, literally costs you nothing in annual fees. Zero. Now, the catch is you have to have a Fidelity account to buy it, but for millions of people, that's an incredible deal. Schwab has their own ultra-low-cost options like the Schwab Total Stock Market Index, SWTSX, with an expense ratio of just 0.03%. The choice between these isn't about finding the absolute cheapest. They are all fantastically cheap. It's about recognizing that this is the league you want to be playing in. This is the standard. Anything significantly more expensive needs a very, very good reason to exist in your portfolio, and frankly, that reason almost never holds up to scrutiny. And what about ETFs? You hear about them all the time. Think of them as index funds that trade like a stock. You can buy and sell them throughout the day. A fund like VTSAX is a mutual fund, meaning all trades are executed at the closing price of the day. Its ETF equivalent is VTI. Functionally, for a long-term buy-and-hold investor, the difference is minimal. The key is the same: a low expense ratio. Whether it's a mutual fund or an ETF, the cost is what matters most. So how do you put this into practice? How do you escape the world of high fees and join the low-cost revolution? Simpler than you think. First, you need a place to invest. This means opening an account. It could be a retirement account like a Roth IRA or a 401k, or it could be a standard brokerage account. Your best bet is to open one directly with one of the low-cost champions: Vanguard, Fidelity, or Schwab. Second, once your account is open and funded, you search for the funds. You don't need a secret decoder ring. You can literally type Total Stock Market Index or S&P 500 Index into the search bar. The tickers we've mentioned, VTSAX, FCROX, SWTSX, are your North Star. Third, and this is the skill we've spent this entire series building, you verify the fees. Look for that line item, expense ratio. See that beautiful tiny number 0.04%, 0.03%, or even 0%. Look for the load fees. You should see the word none or no load. This is your confirmation. This is your green light. You are now in control. You are making an informed decision, not just blindly trusting a salesperson. Finally, you invest and you automate. The single best thing you can do for your future self is to set up automatic recurring investments. Every week, every 2 weeks, every month, a set amount of money is automatically transferred from your bank and invested into your chosen low-cost fund. This strategy, called dollar cost averaging, removes emotion from the equation. You buy whether the market is up or down, ensuring you build your position consistently over time. You put your wealth building on autopilot. Let's go back to where we started. Remember our two investors, both starting with $10,000, both adding $500 a month, and both earning an average 8% annual return before fees? Investor A was in that friendly advisors fund with the 1.25% expense ratio and a sneaky 12b1 fee. Investor B, after watching this series, put their money into a simple total stock market index fund with a 0.04% expense ratio. After 30 years, Investor A, the one paying the small fees, has about $635,000. A respectable sum. But Investor B, the one who took control, who understood the devastating power of costs, they have over $750,000. That's a difference of $115,000. $115,000. That's not a rounding error. That is a luxury car. That's a down payment on a house. That's years of a more comfortable, less stressful retirement. It's the cost of not knowing. It's the price of complexity. It's the wealth that was transferred from your pocket to the balance sheet of a massive financial firm, all because of fees you may not have even known you were paying. The financial world is designed to be confusing. The jargon, the convoluted products, the endless noise, it serves a purpose. It makes you feel like you need an expensive guide to navigate it all. But you don't. The secret to successful investing for the vast majority of us isn't about finding the next Tesla or outsmarting Wall Street. It's about two things: owning a diversified portfolio of great businesses and, most importantly, keeping your costs as close to zero as humanly possible. You now possess the knowledge to do that. You can read a prospectus. You understand expense ratios, loads, and 12b1 fees. You know the devastating impact they have over time. And now you know the alternative. You have the map to a simpler, cheaper, and more effective way to build wealth. Don't ever let anyone tell you that a 1% or 2% fee is just the cost of doing business. It is not. It is the cost of your future. It's your time, your hard work, your dreams. Protect it fiercely. Your financial future is not a game of chance to be played by others. It's a fortress to be built by you. And starting today, you have the tools to build it strong.